All right, welcome back. Today, we are diving into one of the most unbelievable stories in modern finance. A tale about a financial earthquake that wasn't triggered from some Wall Street skyscraper, but from a regular suburban bedroom. So let's just start with this number, $1 trillion. That is how much value was just completely wiped from the US stock market on the afternoon of May 6, 2010. It just disappeared. And it happens so fast, it's almost impossible to wrap your head around it. $1 trillion in wealth, gone, in basically the time it takes to watch an episode of your favorite sitcom. This crazy high-speed collapse baffled everyone and set the stage for one of the strangest financial mysteries of our time. So how in the world did this chaos unfold? You see, on that day, the market wasn't just falling, it was completely breaking apart at the seams. It was absolute pandemonium. The Dow took its biggest nosedive in history, point-wise. You had these huge, stable companies like Procter & Gamble. Their stock just cratered by more than a third. And then things just got straight up weird. I mean, get this. Shares of a global giant like Accenture were trading for a single penny. A penny. At the same time, Apple shares were somehow trading for over $100,000 apiece. The whole system had just lost its mind.
And this quote, man, it just perfectly captures the central puzzle. Everyone from Wall Street to Washington was scrambling, thinking it had to be a huge cyberattack or some catastrophic system failure. But the truth was so much stranger than anyone could have possibly imagined.
The global investigation didn't lead to some high-tech hedge fund or a foreign government. Nope. It led them to a quiet little house in Hounslow, a suburb of London, and to a guy the press would later nickname the Hound of Hounslow. And what's so fascinating is this guy, Navinder Singh Sarao. He was this incredible paradox. Here's a guy who made over $40 million from the markets, but he was still living with his parents in his childhood bedroom. He drove a moped, and apparently he lived on a diet of McDonald's filet-o-fish sandwiches. And get this, the supposed financial mastermind would later lose his entire fortune to a bunch of con artists.
But don't get me wrong, as eccentric as he was, the people who knew him saw him as a trading savant. He had these lightning-fast reflexes and was totally fearless when it came to risk. For him, you see, the market wasn't really about the money. It was a video game, and he was absolutely determined to get the high score.
So the big question is, how did one guy in his bedroom take on the most powerful and sophisticated trading algorithms on the planet? I mean, in the world of high-frequency trading, speed is literally everything. He knew he couldn't outspeed the machines, so he decided he was going to outsmart them. He was basically fighting a war against what he called the high-frequency geeks, these huge firms that use supercomputers to make millions of trades in the blink of an eye. To beat them at their own game, he needed a secret weapon. And that weapon was a technique called spoofing. It's completely illegal, by the way. Think of it like a magic trick for the stock market. You create this massive illusion of selling pressure to fool everyone, or in this case, everything, every algorithm, into thinking the price is about to tank. His playbook was pretty simple, but it was devastatingly effective. Okay, so step one, he'd flood the market with these enormous sell orders that he had zero intention of actually letting go through. Step two, the robot traders see this giant wall of supply and their algorithms just automatically start selling, trying to get ahead of the price drop they think is coming. Then, and this is the genius part, step three, just as the price starts to fall, he'd instantly cancel all his fake orders and swoop in to buy everything up at the new artificially low price. Boom, instant profit. And he wasn't just sitting there clicking away by hand. Oh no, he actually paid programmers to build him a custom piece of software he called NavTrader. It was his weapon, and it was designed to do one thing: automate this spoofing strategy so he could manipulate the market at lightning speed. So that brings us to the day of the crash. Sarao's tool was about to pour gasoline on a market that was already really nervous. You see, everyone was on edge because of the Greek debt crisis. It was basically a tinderbox just waiting for a spark. Okay, so here's how it all went down, minute by minute. At 2:32 p.m., this huge but totally legitimate $4.1 billion sell program starts, and the market gets jittery. 9 minutes later, Sarao's algorithm kicks into high gear, adding enormous, fake selling pressure right on top of the real selling. That combination was toxic. By 2:45, the bottom just completely fell out. The only thing that stopped the free fall was a circuit breaker that automatically paused all trading for just 5 seconds. Just enough time for the system to catch its breath. And look at this chart.
This really puts the scale of his impact into perspective. It's wild. At the absolute peak of the crisis right before the crash, investigators found that Sarao's fake orders accounted for between 20 and 29% of the entire sell side of the market. Think about that. A single trader was creating nearly a quarter of all the selling pressure in the world.
So, in the aftermath, the most powerful regulators in the world were just stumped. They first blamed that big mutual fund, but the story just didn't add up. It would take them almost 5 years and a critical tip from a whistleblower to finally find the real suspect.
I mean, this timeline is just staggering. The crash happens in 2010. It wasn't until April of 2015, 5 years later, that US and UK authorities finally showed up at his parents' front door to arrest him. They had finally traced all those digital breadcrumbs back to his little bedroom.
And they threw the book at him. The charges were serious, 22 counts of fraud and manipulation, carrying a potential sentence of 380 years in prison. His bail was set at over £5 million. But when it came time to actually pay up, there was a shocking twist. The supposed multimillionaire couldn't come up with the cash.
And this is where the story gets truly unbelievable. The man who is accused of being this financial mastermind had fallen victim to a series of con artists himself. They'd apparently stolen his entire fortune. The master manipulator had been masterfully manipulated. You can't make this stuff up.
So after all that chaos, after triggering a $1 trillion market meltdown, what was the final sentence? Incredibly, just 1 year of home confinement. He was sent right back to the very same house where the whole thing started.
So what can we take away from this absolutely bizarre story? What does it tell us about the financial world we live in today?
Well, the takeaways are pretty unsettling. First, it shows just how fragile our complex, high-speed markets really are. Second, it proves that the regulators are often playing catch-up, years behind the technology they're supposed to be policing. And it sparked this huge debate. A lot of smart people argued that blaming the whole thing on Sarao was, and I quote, comical, that he was just a convenient scapegoat for a system that was already fundamentally broken. And really, that's the final, unsettling question I'll leave you with. Was Navinder Sarao a criminal mastermind who single-handedly broke the global economy? Or was he just a scapegoat for a system that was already rigged, a player who just happened to be in the wrong place at the wrong time and got caught? Let me know what you think down in the comments.